Silence before the storm. It's Sunday evening, January 18th, 2026, and I need to tell you something that most people won't realize until it's far too late. I'm a private commodities analyst. I've been tracking physical silver markets for 12 years now, and if you want to know who's actually behind this AI avatar, there's a channel intro on the homepage. But right now, we don't have time for backstories. Right now, while the world is watching football and scrolling through their phones, the global financial plumbing system for silver is hitting a literal brick wall. The mainstream financial media spent Friday afternoon talking about a Greenland real estate deal. They framed it as geopolitics. They called it diplomacy. They used words like negotiating tactic and trade leverage. The screen is showing you a narrative, not reality. This isn't about land. This isn't about Arctic minerals or strategic positioning or any of that surface level analysis you're going to read in the Wall Street Journal tomorrow morning. This is about a physical liquidity trap that is about to strangle the London Bullion Market Association, and by extension, the entire global silver pricing mechanism. Here's what actually happened. On Friday night, the administration dropped what I'm calling the nuclear tariff bomb, 10% tariffs on imports from 8 European Union nations, plus the United Kingdom effective February 1st. That's 14 days from now. And here's the part that should make your hair stand up. That list includes the UK, home of the LBMA, the single most important silver trading hub on planet Earth outside of New York. By the time the opening bell rings tomorrow night, when futures markets open, the economic pathway for silver to move across the Atlantic Ocean won't just be expensive, it will be economically impossible for the bullion banks to maintain their standard operating procedures. But that's not even the worst part. Let me be very clear about what I'm claiming here, because this is not speculative, this is math. Trump's 10% tariff, which escalates to 25% if no Greenland deal is reached by June 1st, has created what I'm calling a one-way valve in the global silver market. It has effectively trapped millions of ounces of physical silver within United States borders, leaving the London markets to starve on their existing inventory. And here's the stake. If the LBMA cannot borrow metal from the COMEX vaults in New York to cover their short positions, the global pricing mechanism breaks down completely. We're not talking about a price squeeze that takes silver from $90 to $110. We're talking about a fundamental fracture in how this metal is valued globally. We're looking at a scenario where if bullion banks need to cover their short positions by withdrawing silver from vaults in New York, the global pricing mechanism breaks down completely. This isn't a minor price squeeze, like silver moving from $90 to $110. Instead, it represents a fundamental fracture in how this metal is valued globally. We are looking at a scenario where physical silver could legitimately trade above $100 per ounce, not due to investment demand, but because of a structural impossibility in the supply chain. In this video, I will explain 3 key points. First, I will detail exactly how this geographic arbitrage trap works and why it is currently the most significant factor in the silver market. Second, we will perform an actual stress test calculation to determine what happens when that 10% becomes 25%. Third, I will share my personal strategy for the Monday open and the subsequent 14 days, as my experience in this market has taught me that when the music stops, it's best to be prepared. Before we proceed, it's crucial to understand a fundamental difference. Gold is the money of kings, central banks hold it, governments hoard it, and it serves as the anchor of the monetary system. However, silver is the Achilles heel of the entire banking system, and that heel is about to be struck. Here is the hard data. As of this afternoon, around 2:30 p.m. Eastern Standard Time, silver was trading at $89.94, a decrease of 1.662% from Friday's close. Gold at $4,596.87, down 0.28%. Based solely on these numbers, one might assume a rational market reaction. Tariffs typically strengthen the dollar, and precious metals usually decline on strong dollar news. The algorithms interpreted the tariffs and executed their standard playbook. However, the paper market has yet to grasp the physical reality occurring beneath these ticker symbols. While paper prices dipped slightly on Friday, the bid-ask spreads began to widen. This widening was not dramatic enough to trigger alerts on CNBC, but those observing the actual physical dealers would have noticed it. The gap between the price someone is willing to pay for an ounce and the price someone is willing to sell for started to increase. Adding to this, The Friday night surprise was the actual tariff announcement, which occurred after the LBMA had already closed for the weekend. London is not yet aware that it is in a trap. To provide further context that highlights the absurdity of this situation, in the first quarter of 2025, we observed millions of ounces of physical silver leaving London vaults and arriving in New York. The bullion banks believed they were acting strategically by front-running the Section 232 review, which was widely anticipated. This context makes the situation even more insane. In the first quarter of 2025, we watched dozens of millions of ounces of physical silver flee London vaults and land in New York. The bullion banks thought they were being smart. Why were front-running the Section 232 review that everyone knew was coming? The Section 232 review is the mechanism the administration uses to determine if imports threaten national security. Silver, as a strategic mineral used in everything from solar panels to missiles, was obviously on that list. So the banks did what banks do. They moved their metal ahead of potential restrictions. They repositioned their physical inventory from the LBMA into COMEX warehouses, thinking they'd be safe from any supply chain disruptions. And now, with one announcement, with one weekend tweet, the door has been locked from the outside. The metal is trapped in New York, and the banks just lost their ability to play whack-a-mole with physical shortages across the Atlantic. How a geographic arbitrage trap actually works, let's slow down here. I'm going to teach you a concept that most retail investors have never heard of, but that institutional traders live and die by. It's called a geographic arbitrage trap. Here's the simple definition. This occurs when the cost to move an asset between two global exchanges becomes higher than the price difference between those exchanges. When that happens, the flow of supply completely paralyzes. Let me give you an analogy that makes this crystal clear. Imagine you have two wallets. Your left pocket, let's call it London, is completely empty and you've got a bill due that you need to pay immediately. Your right pocket, New York, is stuffed full of $100 by LS. Normally, you just move some cash from your right pocket to your left pocket and solve the problem. But here's the catch. Every single time you move a $100 bill from your right pocket to your left, the government intercepts it and takes $25 as a tax. You're technically rich in one pocket and functionally bankrupt in the other, and you can fix the problem without losing 25% of your wealth in the process. That's a geographic arbitrage trap. Now, let's apply this to silver markets today. The United Kingdom, specifically the LBMA, is critically short of physical silver. They've got obligations, they've got contracts, they've got delivery demands from funds and industrial users who need actual metal, not paper promises. Under normal circumstances, this wouldn't even be a problem. And when London gets short, they just arrange a shipment from New York. Metal moves across the Atlantic every single week as part of the global flow that keeps prices synchronized between exchanges. Users who need actual metal, not paper promises. Under normal circumstances, this wouldn't even be a problem. When London gets short, they just arrange a shipment from New York. Metal moves across the Atlantic every single week. It's part of the global flow that keeps prices synchronized between exchanges. The mechanism works like this. If silver is trading at $90 in New York and $91 in London, arbitrage traders will buy in New York, ship it to London, sell for a $1 profit, and pocket the differ. Hence, after shipping costs. That constant flow of metal from low price to high price zones is what keeps global markets balanced. But with a 10% tariff and eventually a 25% tariff, that metal can never economically return to the United States without the banks taking a massive loss. Think about what that means. If you're a bullion bank and you ship 1 million ounces from New York to London to cover a short position, you've just made that metal 25% more expensive to ever bring back. The result is that two separate prices for silver are about to emerge. I'm calling them the trapped US price and the starving London price. And when those two prices decouple, when the arbitrage mechanism breaks down completely, we're going to witness something that hasn't happened in modern precious metals markets. Let me walk you through the actual math, because this is where theory becomes reality. Scenario A, the 10% friction. At $90 per ounce, a 10% tariff adds $9 to the cost of every single ounce imported into the United States. What does that mean practically? It means that if silver is trading at $90 in New York and $95 in London, it's still not profitable to ship metal from London to New York, because you'd pay $9 in tariffs and lose $4 on the trade. This immediately creates a floor for US physical metal. Domestic silver cannot fall below the London price minus the tariff cost, or arbitrage would kick in and equalize things. But here's where it gets dangerous. Scenario B, the 25% nuclear op is Tion. If no Greenland deal is reached by June 1st, and I personally think the odds of a deal are lower than the media is suggesting, the cost to bring silver back into the United States jumps by $22.50 per ounce at current prices. Let me say that again, $22.50. 50 cents per ounce. Now, the LBMA is rumored to be critically short. I don't have exact figures because the banks don't publish their short positions in real time, but based on the inventory drawdowns we saw in first quarter of 2025, we're talking about potential exposure in the price is $22.50, which is 50 cents per ounce. Now, the LBMA is rumored to be critically short. I don't have exact figures because the banks don't publish their short positions in real time. But based on the inventory drawdowns we saw in first quarter of 2025, we're talking about potential exposure in the range of 50 million ounces or more. If they need 50 million ounces to satisfy delivery obligations, and the United States is the only source of available physical metal, the premium required to move that metal has to exceed the 25% tariff. Here's the calculation that should terrify anyone short silver right now. The current price is $89.94. Add 25%, and that's $112.42. That is the mathematical break-even point for global silver flow under the 25% tariff scenario. $112.42 is not a speculative price target. It's not a hopeful projection from a gold bug who thinks the dollar is going to collapse. It's the minimum price required for arbitrage to function under T. He knew tariff structure. Now, look at the COMEX inventory charts. I was looking at them a few hours ago, and here's what you need to understand. The registered silver, the metal that's available for delivery, isn't moving. It's sitting there. Not because there's no demand, but because the banks can't afford to let it leave. Every ounce that exits a US vault is an ounce that becomes 25% more expensive to replace. The smart money has already figured this out. They're not selling, they're not shipping, they're sitting on their metal and waiting for London to blink. Now, I know exactly what the skeptics are going to say. I've been in this market long enough to predict the counter-arguments before they even show up in the comment section. Skeptic argument number one, this is just a negotiating tactic for Greenland. Silver is a strategic mineral. It'll be exempted before February 1st. Here's my rebuttal. Look at the Section 232 review that was completed just days ago. Read the actual language. It purposefully left the door open for broad-based tariffs on all goods from the listed nations. If the administration wanted to exempt strategic minerals, they would have done it in the initial announcement. The fact that they used the phrase all goods is not an accident. It's a pressure tactic designed to maximize economic pain and force concessions. And here's the thing about negotiating tactics. They only work if the other side believes you'll actually follow through. If you announce a 10% tariff with an escalation to 25%, and then you immediately grant exemptions, you've shown your hand. You've revealed that it was a bluff. This administration doesn't bluff on tariffs. We've seen this playbook before. Skeptic argument number, the other side believes you'll actually follow through. If you announce a 10% tariff with an escalation to 25%, and then you immediately grant exemptions, you've shown your hand. You've revealed that it was a bluff. This administration doesn't bluff on tariffs. We've seen this playbook before. Skeptic argument number two, the UK isn't even in the European Union anymore. The tariff won't apply to them. Wrong. The announcement explicitly named the United Kingdom alongside the EU nations. Go back and read the press release. It's right there in black and white. 8 EU nations plus the UK. Brexit doesn't protect London from this. If anything, it makes them more vulnerable because they don't have the collective bargaining power of the EU to negotiate exemptions. Skeptic argument number three, the COMEX will just change the rules. They'll allow cash settlement or adjust delivery terms to avoid a squeeze. This one actually has some merit. The exchanges have changed rules before when things got tight. But here's what the skeptics miss. Changing the rules doesn't create physical metal. If the LBMA has contracts that demand physical delivery and they can't source the metal because of the tariff trap, no amount of rule changes in New York, so LV's their problem in London. You can't settle a physical delivery obligation with a PDF file. Let me give you my personal dashboard for the next 14 days because this is about to move fast. First, I'm watching for margin hikes on the COMEX. I expect them by Tuesday or Wednesday. When volatility spikes, or when the exchange perceives a squeeze forming, they raise margin requirements to shake out the small speculators. It's standard procedure. If you're trading silver futures on leverage, a 20 or 30% margin hike can force you to either post more cash or liquidate your position. This is how they engineer sell-offs in paper markets while the physical market is tightening. Second, I'm watching the media for what I call the blackout, when things get truly dangerous for the banks. You'll see either complete silence on the topic or you'll see technical difficulties in reporting. Watch for redefinitions of what constitutes available silver in London. They'll start separating allocated from unallocated, or they'll start talking about liquidity instead of inventory. It's a linguistic shell game designed to obscure the fact that they're running out of metal. Third, and this is the big one, I'm watching the EFP spread. EFP stands for exchange for physical. It's the mechanism that allows traders to swap a futures contract for actual metal. The spread between the futures price and the physical price is normally very tight, maybe a few cents. If that spread blows out, the big one I'm watching is the EFP spread. EFP stands for exchange for physical. It's the mechanism that allows traders to swap a futures contract for actual metal. The spread between the futures price and the physical price is normally very tight, maybe a few cents. If that spread blows out to $1, $2, or $5 per ounce, it means the paper market has completely decoupled from the physical market. That's the signal that the system is breaking. Fourth, I'm watching every single headline out of Greenland. Any indication of a breakdown in talks, any statement from Danish officials that negotiations are stalling, is a bullish signal for silver. This is because every day that passes without a deal is another day closer to February 1st, when the 10% tariff kicks in. And every day after June 1st without a deal is another day under the 25% regime. The banks have 14 days to solve a problem that's been building for 100 years. They've papered over physical shortages with derivatives, with leasing agreements, with accounting tricks that let them count the same ounce of silver in 3 different places. But you can't tariff your way out of physics. Time is not on their side. My personal battle plan for the next 2 weeks. I want to be very clear about something before I share this. I am not your financial advisor. I'm not telling you what to do with your money. I'm a guy who's been stacking physical silver for over a decade, and I'm watching a train wreck happen in slow motion. This is my person. Our playbook. You do whatever makes sense for your situation. Trigger number 1 is the $92 level. If we open Sunday night, when futures markets come back online and silver gaps over $92, I'm viewing that as the market confirming the tariff trap. That would represent a breakout above the recent consolidation range. And more importantly, it would show that institutional money is starting to price in the geographic arbitrage trap. If that happens, I'm holding my core physical positions with zero intention of selling. I don't care if it hits 100. I don't care if it hits 120. The metal stays in the safe. Trigger number 2 is registered inventory movements. I'm watching the COMEX warehouse reports like a hawk. These come out daily and show you exactly how much silver is in the registered category versus the eligible category. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting in the warehouse but not earmarked for delivery. If I see large amounts of silver moving from registered to eligible, it means the big players are tucking their metal away. They're taking versus the eligible category. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting in the warehouse but not earmarked for delivery. If I see large amounts of silver moving from registered to eligible, it means the big players are tucking their metal away. They're taking it off the table, making it unavailable for the scramble that's coming. That's a bullish signal. Trigger number 3 is the dip on It's Just a Bluff headlines. If silver dips to $85 this week because the mainstream media runs stories about how this is just a negotiating tactic and cooler heads will prevail, I am personally looking to add to my physical stack. I view that as a gift. It's the market giving me one last chance to buy at a discount before the reality sets in. I'm not talking about leverage futures contracts or options. I'm talking about physical metal that I can hold in my hand. Trigger number 4 is margin hikes above 20%. If the COMEX hikes margins by more than 20% in a single day, I'm sitting on my hands. I'm not playing the paper game at that point. Margin hikes are a signal that the exchange is trying to suppress price by forcing speculators out. When they're that aggressive about it, it usually means the physical situation is worse than they're letting on. At that point, I let the physical metal do the work. I don't try to trade around it. Trigger number 5 is the London-New York spread. This is the nuclear option indicator. If the spread between London spot prices and New York spot prices hits 5% or more, I'm preparing for a force majeure event. Force majeure is the legal term for we can't deliver because of circumstances beyond our control. It's the escape hatch that exchanges use when they can't meet their obligations. If that spread hits 5%, it means arbitrage has completely broken down. It means the one-way valve is fully closed. It means we're in uncharted territory. At that point, my personal plan is simple. Hold physical, avoid paper, and wait for the dust to settle. What the banks are really afraid of. Let me pull back the curtain on something that doesn't get talked about enough in the silver community. The bullion banks are not afraid of high silver prices. They've seen silver at $49 in 2011. They've navigated higher gold prices. They can hedge, they can adjust their books. What they're afraid of is a market where they can't move metal to where they need it. The entire fractional reserve system in precious metals depends on geographic flexibility. When London they've navigated higher gold prices. They can hedge, they can adjust their books. What they're afraid of is a market where they can't move metal to where they need it. The entire fractional reserve system in precious metals depends on geographic flexibility. When London gets tight, metal flows from New York. When New York gets tight, metal flows from Zurich, Singapore, or Hong Kong. It's a global shell game, and it only works as long as the shells can move freely. The moment you lock down one of the major shells, the whole illusion falls apart. And that's exactly what this tariff has done. It's locked down the New York shell. The LBMA can't borrow from COMEX anymore, not at prices that make economic sense, and not without taking catastrophic losses on the round trip. So, what do they do? Oh, they've got 3 options, and all of them are bad. Option 1, they let physical silver in London spike to $100 or more to incentivize existing holders to sell. Option 2, they change the rules and allow cash settlement, which destroys confidence in the entire LBMA system. Option 3, they declare force majeure and admit they can't meet their delivery obligations. Pick your poison. Every single one of those options is catastrophic for the paper silver market, and every single one of them is bullish for anyone holding physical metal. Here's a piece of context that makes this entire situation even more absurd, the front-running scandal. They don't want you to remember it. In the first quarter of 2025, we saw this massive movement of silver from London to New York. I mentioned it earlier, but I want to dive deeper into what actually happened. The banks knew that a Section 232 review was coming. They knew that silver was going to be classified as a strategic mineral. They knew that import restrictions were possible. So, what did they do? They moved their metal ahead of time. Dozens of millions of ounces flowed out of LBMA vaults and into COMEX warehouses in New York. It was the single largest quarterly movement of silver between those two markets in recent history. And the beautiful irony is that they thought they were being smart. They thought they were front running the restrictions. They thought they were positioning themselves to be on the right side of the trade. And the tariffs hit. But they made one critical miscalculation. They assumed the tariffs would restrict imports into the United States, not exports out of the United States. They moved the metal into the US to protect it from import tariffs. And now they've realized that it's the export side. When the tariffs hit, they made one critical miscalculation. They assumed the tariffs would restrict imports into the United States, not exports out of the United States. They moved the metal into the US to protect it from import tariffs. And now they've realized that it's the export side that's trapped. It's like a bank robber who breaks into the vault, stuffs his bag with cash, and then realizes the only door out is locked from the outside. They're stuck. And the best part is, they did it to themselves. This week is different from every other squeeze attempt. I've been through a lot of silver rallies. I was around for the 2011 spike. I've watched countless to the moon predictions fizzle out. And I know that a lot of people in the silver community have developed a kind of cynicism about squeezed narratives. We've heard it all before. This is the big one. The banks are finally going down and then nothing happens. The price rallies for a week, the banks slam it back down, and we're back where we started. So let me tell you why this time is structurally different. Every previous squeeze attempt has been demand-driven. It's been about investment demand overwhelming supply. It's been about retail buyers or hedge funds piling into the market and trying to corner physical metal. And every single time the banks have had the same response. They short more paper, they lease metal from central banks, and they move physical inventory from other global vaults to wherever the pressure is building. They've always had geographic flexibility as their release valve. This time, that release valve is gone. This isn't about demand, it's about supply chain paralysis. It's about a policy decision that has created a structural barrier to the normal flow of metal. You can't short your way out of a tariff. You can't lease metal from a central bank if that metal can't economically cross the Atlantic. The normal tools that the banks use to suppress price don't work when the fundamental problem is logistics. And that's why this week could be the catalyst that finally breaks the paper market, the Greenland variable. Let's talk about the elephant in the room. This entire tariff structure is theoretically contingent on Greenland negotiations. The administration has made it very clear. Make a deal on Greenland and the tariffs go away. Fail to make a deal and the 10% becomes 25% by June 1st. So the obvious question is, what are the odds of a deal? I've been reading everything I can find on the Danish government's position, on Greenland's own political situation, on the broader and the tariffs go away. Fail to make a deal and the 10% becomes 25% by June 1st. S. O. The obvious question is, what are the odds of a deal? I've been reading everything I can find on the Danish government's position, on Greenland's own political situation, and on the broader geopolitical context. And here's my personal assessment. The odds of a comprehensive deal by June 1st are below 30%. Here's why. Greenland is not just a piece of real estate. It's a sovereignty issue for Denmark, a cultural issue for Greenlanders, and a strategic issue for the entire European Union. Because if the US gains control of Greenland, it fundamentally shifts the balance of power in the Arctic. This isn't like buying an office building. You can't just write a big enough check and close the deal. There are political constituencies in Denmark that would rather see their government fall than sell Greenland. There are Greenlanders who view any sale as a betrayal of their autonomy. And critically, there's no urgency on the European side. From their perspective, they can just wait out the tariffs, they can absorb the economic pain, and they can hope for a change in US policy after the next election. They're playing a long game, and the administration is playing a short game, which means the odds of a breakdown in talks are significantly higher than the market is currently pricing in. And every day that ticks by without progress is another day closer to the 10% tariff becoming reality. What the charts aren't telling you. I want to address something that drives me crazy about how most people analyze precious metals markets. They look at price charts, they look at technical indicators, they draw trend lines and Fibonacci retracements, and they try to predict the next move based on patterns. And all of that is fine for normal markets. It works reasonably well for stocks or Forex or even gold most of the time. But silver is not a normal market. Silver has a physical supply constraint that doesn't show up on any chart. You can't see a geographic arbitrage trap in a candlestick pattern. You can't draw a trend line that predicts a force majeure event. The price you see on your screen is a derivative of a derivative of a derivative. It's a futures contract based on a spot price, based on a flow of metal that may or may not actually exist in the quantities that the market assumes. And when that underlying flow breaks down, the chart doesn't give you any warning. The chart shows $89.94. It shows a 1.62% decline from Friday's close. It looks calm, but underneath, on a flow of metal that may or may not actually exist in the quantities that the market assumes. And when that underlying flow breaks down, the chart doesn't give you any warning. The chart shows $89.94. It shows a 1.62% decline from Friday's close. It looks calm, but underneath that calm surface, the physical market is seizing up. Dealers are widening spreads. Refineries are backlogged on orders. Industrial users are panic buying because they know what's coming. None of that shows up on the chart until it's too late. By the time the chart reflects the physical reality, the move has already happened. You're not getting in at $90, you're chasing it at $110. This is why I focus on physical inventory data, on spreads, on delivery patterns, because those are the leading indicators that actually matter. The chart is the lagging indicator. It tells you where we've been. It doesn't tell you where we're going. The two-price world we're about to enter. Let me paint you a picture of what I think the next 3 months look like if this tariff holds. By early February, we're going to start seeing a persistent premium for physical silver in London relative to New York. It'll start small, maybe 2% or 3%. The mainstream media will call it a temporary dislocation or regional supply constraints. By March, that premium will widen to 5% or 6%. Dealers in London will be charging $100 per ounce, while New York is still trading at $95. The arbitrage traders will look at that and say, why don't we just ship metal from New York to London and capture that $5 spread? And then they'll remember the tariff. They'll remember that shipping. An ounce to London means paying a $9 or $22 tariff to bring it back. And they'll realize the arbitrage doesn't work. By May, if there's still no Greenland deal, we're looking at a 10% to 15% spread. London's silver at $120, New York's silver at $105. And at that point, the LBMA has a choice to make. Do they keep allowing physical delivery at these elevated prices, or they implement cash settlement? If they choose cash settlement, confidence in the entire system evaporates. Every holder of a London silver contract realizes that their contract is not backed by actual metal. It's just a paper promise that can be settled in fiat currency at the exchange's discretion. And if that happens, the flight to physical accelerates. Everyone who thought they owned silver through an ETF or a vault storage program suddenly realizes they own a claim on silver, not actual silver. And the premium for metal you can hold in your fiat currency at the exchange's discretion. And if that happens, the flight to physical accelerates. Everyone who thought they owned silver through an ETF or a vault storage program suddenly realizes they own a claim on silver, not actual silver. The premium for metal you can hold in your hand goes vertical. This is the two-price world we're entering. Paper silver at one price, physical silver at another price, and a widening chasm between them. The industrial demand factor everyone's ignoring is something that doesn't get nearly enough attention in these squeeze scenarios. Industrial demand for silver is not optional. It's not like investment demand where someone can just decide, I'll wait for a better price. If you're a solar panel manufacturer, you need silver. If you're making semiconductors, you need silver. If you're producing medical devices, electric vehicle components, or military hardware, you need silver, and you need it on a schedule. You can't just tell your production line, sorry, we're going to pause for 3 months while we wait for silver prices to come down. Your contracts have deadlines, your customers have orders, and your factory has overhead. So what happens when industrial buyers realize that the normal flow of silver from COMEX to wherever they need it has been disrupted by a 25% tariff? They panic buy. They lock in supply at any price. They build inventory buffers that they normally wouldn't carry because the cost of running out is higher than the cost of overpaying. That industrial bid, that non-price sensitive demand, is what pushes the market over the edge. Industrial buyers don't care if silver is at $90 or $110. They care about securing supply and keeping their production lines running. When you combine that industrial bid with a geographic arbitrage trap that's preventing normal supply flows, you get a price spike that doesn't respond to normal market dynamics. The banks can short all the paper they want. It doesn't matter. The industrial buyers need physical metal, and they're going to pay whatever it takes to get it. Why? I'm not worried about a crash. This week, I'm going to make a prediction that might sound counterintuitive given everything I've just told you. I don't think we're going to see a crash this week. I don't think silver is going to fall back to $70 or $60. And here's why. The market hasn't fully priced in the tariff trap yet. Most participants are still operating under the assumption that this is a negotiating tactic that will be resolved before February 1st. But the smart money, the institutional players who actually move physical metal, they're not selling. And here's why. The market hasn't fully priced in the tariff trap yet. Most participants are still operating under the assumption that this is a negotiating tactic that will be resolved before February 1st. But the smart money, the institutional players who actually move physical metal, they're not selling, they're holding. They're waiting to see which way this breaks. And as long as the physical holders aren't selling, there's a floor under the price.
Could we see a dip to $85 on It's Just a Bluff headlines? Absolutely. I'm planning for that scenario. But a full crash back to the 70s, I don't see it.
There's too much physical demand. There's too much industrial buying. There's too much awareness among large holders that something structural is changing. The downside risk is limited. The upside risk is unlimited. And that's a risk-reward profile that I'm very comfortable with. My message to the paper traders, if you're someone who trades silver futures, who uses leverage, who plays the paper market for short-term gains, I want to say something directly to you. You're playing a game that's about to change its rules in the middle of the round. The normal patterns don't apply anymore. The normal support and resistance levels don't matter. The normal correlations with the dollar or with gold or with equities are breaking down. When you're trading a geographic arbitrage trap scenario, technical analysis is almost useless. You're not trading sentiment or momentum. You're trading logistics and policy. And if you're on the short side of this trade, either directly or through selling covered calls or any other bearish strategy, you need to understand that your risk is not symmetrical anymore. The downside might be $10. The upside might be $50. And margin calls don't care about your thesis. I'm not telling you to close your positions. I'm not giving you advice. I'm just saying what game you're playing. Understand that the referee might change the rules. Understand that the floor could fall out or the ceiling could blow off, and your stop loss might not protect you. If that doesn't scare you, then trade away. But if it does scare you, there's no shame in sitting this one out. The 14-day countdown. We are now 14 days away from February 1st when the 10% tariff officially kicks in. 14 days for the LBMA to source metal. 14 days for the banks to reposition. 14 days for Greenland negotiations to either produce a deal or fall apart completely. 14 days for the market to wake up to what's happening. I've been doing this for 12 years, and I've never seen a setup quite like this. I've seen supply squeezes. The banks need to reposition. There are 14 days for Greenland negotiations to either produce a deal or fall apart completely. There are 14 days for the market to wake up to what's happening. I've been doing this for 12 years, and I've never seen a setup quite like this. I've seen supply squeezes, price manipulation, regulatory changes, and demand shocks. But I've never seen a scenario where a single policy decision created an immediate structural barrier to the normal functioning of a global commodity market. This is not a prediction about silver going to $100 based on investment demand, inflation fears, or dollar devaluation. This is an observation that the plumbing is broken. The pipes that normally allow silver to flow from New York to London have been crimped by a 25% tariff, and nobody has figured out how to uncrimp them yet. When the plumbing is broken, pressure builds. It doesn't matter if anyone wants higher prices. It doesn't matter if the banks try to suppress it. Physics doesn't care about your short position. Let me bring this home. It is Sunday evening, January 18th, 2026. Silver is trading at $89.94. The markets are quiet. The mainstream media is talking about Greenland, diplomacy, and geopolitics. Underneath all of this, at noise, a physical liquidity trap is tightening around the LBMA. In 14 days, the cost to move silver across the Atlantic increases by 10%. In less than 5 months, that cost could be 25%. The banks moved millions of ounces into US vaults, thinking they were front-running import restrictions. Instead, they trapped themselves. The LBMA is short, the COMEX is the only source, and the door between them is closing. I'm holding my physical silver, I'm watching the triggers I outlined, and preparing for a market that could legitimately trade above $100, not because of hype, but because of math. You've been given the information, you've seen the numbers, you understand the mechanism. What you do with that information is entirely up to you. But don't say you weren't warned when you wake up one morning and silver is trading at $115, every dealer is sold out, and the premiums are 30% over spot, and you're wondering how you missed it. The signal was sent this weekend. The question is whether you're going to listen. If you want to understand how the banks set this trap for themselves in the first quarter of 2025, how they moved all that metal ahead of the Section 232 review, there's a deep dive on that topic that I'll link in the description. But right now, you need to be focused on the next. This is the end of the transcript. Make sure to conclude properly. The banks set this trap for themselves in the first quarter of 2025, moving all that metal ahead of the Section 232 review. Reads a deep dive on that topic that I'll link in the description. But right now, you need to be focused on the next 14 days because the clock is ticking and the valve is closing. When it fully shuts, we're going to find out exactly how much physical silver actually exists versus how much paper silver has been promised. I have a feeling the answer is going to surprise a lot of people. Stay sharp, watch the data, and trust the math.